When most people decide where to keep their money, they walk into the nearest bank, open an account, and move on without asking whether that was actually the right choice. It is one of the most automatic financial decisions people make, and also one of the least examined. The institution you bank with affects the fees you pay, the interest rates you receive on loans and savings, and the overall cost of just managing your money over time. Understanding the difference between your two primary options, banks and credit unions, is a starting point for making that decision deliberately rather than by default. A bank is a for-profit financial institution. It is owned by shareholders, and like any business, its primary objective is to generate profit. Banks do this by collecting deposits from customers, lending that money out at higher interest rates, charging fees for various services, and investing the capital they hold. The profits generated go back to shareholders in the form of dividends and stock appreciation. That structure is not inherently bad, but it is important to understand because it shapes every product and policy the bank offers. When a bank charges a monthly maintenance fee, sets a minimum balance requirement, or offers a savings account with a very low interest rate, those decisions are driven by a profit motive. The customer relationship is transactional. You're using a service, and the bank is earning money from your business. A credit union operates on a fundamentally different model. Credit unions are nonprofit financial cooperatives. They are owned by their members, meaning the people who have accounts at the credit union are also part owners of the institution. There are no outside shareholders to pay. Because the goal is not to generate profit for investors, any surplus revenue the credit union earns is returned to members in the form of lower fees, better interest rates on loans, and higher interest rates on savings accounts. The structure is cooperative by design. When you deposit money in a credit union, you are not just a customer. You are a member of the institution. The practical differences between banks and credit unions tend to show up most clearly in three areas: fees, interest rates, and access. On fees, credit unions generally charge less. Monthly maintenance fees are less common, and when they do exist, they tend to be lower. Overdraft fees, ATM fees, and minimum balance requirements are often more favorable at credit unions than at traditional banks. This does not mean banks are universally more expensive, but the structural incentive at a credit union is to keep costs low for members, while the structural incentive at a bank is to generate revenue. On interest rates, the same principle applies in both directions. Credit unions typically offer lower interest rates on loans, including auto loans, personal loans, and mortgages, because they do not need to build in a large profit margin. They also tend to offer higher interest rates on savings accounts and certificates of deposit, because they're sharing their surplus with members rather than paying it out to shareholders. If you're carrying any kind of loan or looking to build savings, those differences in rates can add up to a meaningful amount of money over time. On access, banks generally have the advantage. Large national banks like J.P. Morgan Chase, Bank of America, and Wells Fargo operate thousands of branches and tens of thousands of ATMs across the country. They also tend to invest more heavily in digital banking technology, mobile apps, and customer service infrastructure. There are also financial technology companies, commonly called neobanks or online banks, that deserve a brief mention here. These are digital-first financial institutions that operate without physical branches. Examples include Chime, Ally, and SoFi. They often offer very competitive rates and low fees because they do not carry the overhead costs of maintaining physical locations. Most neobanks are not banks themselves, but partner with FDIC-insured banks to hold customer deposits, which means the insurance protection is still in place. They are worth considering, particularly for people who do all of their banking digitally and do not need in-person services. They do not replace the bank versus credit union decision so much as they add a third category worth being aware of. So how do you actually choose? There is no universal right answer, but there is a useful framework. If you prioritize a wide physical network, advanced digital tools, and do not mind paying more in fees, a large national bank may be the better fit. If you prioritize lower fees, better rates on loans and savings, and are comfortable with a more regional or digital experience, a credit union is likely the better choice. If you do most of your financial activity digitally and want to maximize the interest rate on your savings, an online bank is worth exploring. Many people maintain accounts at more than one institution, using each for what it does best. The most important thing is that you make this choice intentionally. The default option, opening an account at whatever bank has a branch near you, is not a strategy. It is just inertia. Understanding what you are choosing between means you can make a decision based on your actual needs and financial situation rather than convenience alone. The worksheet walks you through building one for yourself. If a video covers your paycheck, the worksheet helps you break down your own. The goal is not that you finish this course understanding things better in theory. The goal is that you finish doing things differently in practice. The worksheets are how you close that gap. There is also a glossary available on the Stepping Stones financial website with over 400 financial terms and plain language definitions. If a word comes up in any video that is unfamiliar, the glossary is there to give you a clear answer without having to search elsewhere. Each video in this course covers one focused topic. Some will be concepts you have heard of but never fully understood. Some will cover things you did not know you needed to know until now. The videos are designed to be watched in order, but if something is happening in your life right now and you need to go directly to a specific topic, that is completely fine. This course is free and available to you at any time. The path forward is straightforward. Financial hardware first, then rules of the game, then growth engine. 3 modules, 24 lessons, and 1 objective to give you a complete and practical understanding of how money works in the United States so that you can make decisions with clarity, avoid the mistakes that set people back for years, and build toward the financial position you are working toward. Where you keep your money is not a minor administrative detail. It is a decision that affects what you pay, what you earn on your savings, and the terms under which you borrow. It deserves the same attention you would give any other financial decision.